Guten Tag, IB Econ. We have a new video today. It's the bee's knees by the big cheese himself, Mr. Linegar. Let's make history today as we draw over Unit 3, our macroeconomics review. Concepts 4 through 7 will be finishing macroeconomics. But first, let's do our daily punishment. I can't believe it got fired from the calendar factory. All I did was take a day off. All right, we talked about this last time. Let's talk about economic goals. For economic growth, it's defined as increase in real GDP over time. It could be GNI. We're going to learn the formula in a second for what economic growth is. It's comparing from year to year. It's a way to economic growth could keep a stable rate of inflation and unemployment. It can fluctuate over the course of years, and it does follow the concept of the business cycle, which we learned about in the last video. The 5 goals of macroeconomics, remember, employment, price stability, economic growth, income distribution, and economic stability. When we talk about economic growth, we could talk about short-term economic growth. This is just a movement when there's a recession and getting back to full employment from like point A to point C on this PP graph right here. This would be actual growth or short-term growth. We also have long-term growth, also known as potential growth. This is when there is a change in the quantity or qualities of the factors of production, improvement in technology, efficiency, or changes in institutions. This would cause LRAS to shift right. On the PPC model, it would lead to a new PPC line. This again shows actual growth and potential growth. So here's the first formula you need to know. This is how to calculate economic growth. You look at real GDP in year 2 minus real GDP in year 1 divided by real GDP in year 1 times 100. There are some examples right here to show you. I like using this version better just because, you get confused with the 2 and the 1. It's the new GDP minus the old GDP divided by the old GDP times 100. So as far as economic growth goes, aggregate demand will tend to steadily increase as population size and income grows. Without supply side improvements to shift LRAS, inflation would occur. However, if economic growth does occur and LRAS shifts, this will result in non-inflationary economic growth. As you could see in this line right here, the price level actually goes down from LRAS 2 to LRAS 1. Non-inflationary growth can result in lower unemployment levels due to increased levels of real output. Usually, economic growth will result in an increase in the living standards. In general, we'll live better standards than our parents before us, better lives. Economic growth can result in advancements in other fields, medicine, technology. It might lead to higher wages, more tax revenue. This could lead to more increase in government spending. It could also result in competitive terms of trade on the international markets. Some of the negatives of economic growth are just because your income is going up, that doesn't mean you are always living a better life. Economic growth doesn't always lead to increase in real wages. It may lead to, at the expense of individual liberties or civil liberties. It can lead to structural unemployment, and it can have negative effects on sustainability and the environment. We're next going to talk about equity with equality. We're going to be going over income disparity and equity. Equality is where economic outcomes are the same for different people or different social groups. Equity doesn't mean that everyone should get the same treatment. It recognizes that all people are different. It's about fairness. It means that despite their differences, everyone should be given the same opportunities to succeed. And you can see the differences between equity and equality right here with the bikes. I've shown you some other pictures before. We're mostly talking about equity here, although we will be talking about inequality also. When we measure inequality, we look at a Gini coefficient. A Gini coefficient looks at the cumulative percentage of total income and the percentage of the population. It creates a graph drawing a Lorenz curve, and it sees how equal the society is. The lower the number, the more equal it is. The higher the number, the less equal it is. This right here is the Lorenz curve. On the y-axis, you have total percentage of income. On the x-axis, you have cumulative percentage of total population. You have the line of perfect equality right here. And then you have a little concave line. This represents a country. And then you have the second line, Brazil. This represents a second country. The ones that's closer to the line of perfect equality, Croatia has more equality compared to Brazil. You could also use the line of equality, the Lorenz curve, to show the result of government policies. So, for example, this could be for a corporate tax cut, and this could be after a corporate tax cut. It leads to greater inequity. And this right here just goes on talking about the Lorenz curve and what it is. I like this graph a little bit better. We're next going to talk about inequality of wealth. Inequality of wealth, one of the big things is income. Income includes all money that people earn from wages, salaries, interest, from savings and stocks and bonds, dividends, capital gains. Wealth is the total value of all persons' total assets minus the liabilities. The global wealth gap has significantly increased, and the global is significantly larger than the global income gap. There's a much bigger disparity in the wealth gap compared to the global income gap. So inequality and poverty are linked. When there's a high level of income inequality, it means that a significant portion of a population is living in some form of poverty. We're going to talk about two forms of poverty: absolute poverty and relative poverty. Absolute poverty right here is a term you should know. It's an income of a person. It's not enough for them to meet the basic needs of shelter, food, safe drinking water, and healthcare and education. The international poverty line for absolute poverty is $1.90 per day. In America, we talk about poverty, but mostly is relative poverty compared to the rest of the world. Relative poverty is a comparative measure based on the living standards in a particular country or a region or a city. So you might not have absolute poverty, but if I'm living in Compel, I might be in relative poverty. There's different ways to measure poverty. Each country and economy sets their own national poverty line, which reflects relative poverty. We are going to talk about some of the indexes, and we're going to talk about these indexes when we get to Unit 4 as well. The first one you should know is the Multidimensional Poverty Index, the MPI. For the MPI, they look at three different things in measuring poverty, and you do need to know this. And these three things, they look at health, education, and standard of living. There are, however, difficulties in measuring poverty. There are different types of poverty. Each type of poverty has its own definitions and varies from country to country. It can be difficult to measure. Some types of poverty are difficult to quantify, like the feelings of uncertainty, vulnerability, fear. All those things are not quantifiable. Poverty is normally measured through surveys, which are difficult to conduct and sometimes unreliable. As far as causes of inequality and poverty, we have unequal opportunities. As previously discussed, people are born into various different circumstances. This changes their ability to access opportunities. A teenage born in poverty may have to quit or suspend their education to help. We have the whole poverty trap, which we're going to talk about in Unit 4. This gets to social mobility, what it is, and whether it really exists. Intragenerational social mobility is the ability of an individual to move from one income level to a higher income within their own lifetime. So if I, Ryan Linegar, can move from middle class to upper class, that's intergenerational. Intergenerational is the ability of a person to move to a higher level of income than their parents. So they are two different things. Some of the continuing with the causes of poverty, we have discrimination. It could be racial, gender, sexual orientation, or based on socioeconomic status. Low-income students tend to be discriminated based on their number of educated opportunities available to them. They have less opportunity for college and high-paying jobs. Wage discrimination will occur when workers in a similar position get different wages. You see this a lot with gender, race, ethnicity, even sexual orientation. We also have differences in human capital. There's differences in skilled versus unskilled labor when it comes to wages, and the gap between them is increasing. This is a little bit more understandable for skilled and unskilled labor. They're providing two different services, but that's the next thing. You have different levels of ownership of resources, particularly capital. Globalization and technological progress have affected different types of labor activity. Due to the increase of manufacturing technology, the value of labor has been depreciated in the sector, and the value of skilled labor with higher educational skill sets are needed. Sometimes we talk about a hollowing out of the middle class jobs like a factory worker, and this is what we're talking about here. As far as other causes of poverty, some people blame market-oriented supply-side policies. Deregulation, they say, has increased the opportunity for there to be wealth disparity. The deregulation has caused instability within the market and led to things like the 2007-2008 crash. Workers have lost rights, and there's been a push to deunionize many industries. We get standard versus non-standard employment. Government tax benefit policies continuing on. While what most countries have progressive tax policies, there are regressive tax policies or policies that favor the richer social income groups, and unequal statuses and power. There has been large ownership of capital by the wealthy, and they predominantly dominate politics. Continuing on, consequences of inequality and poverty. Economists would argue that the gap in inequality fuels people to be innovative and there are incentives for entrepreneurship, so that is one positive about it. On the other hand, however, there is large inequality in the amount of people engaged in the economy in a meaningful way, and it has decreased. For living standards and social mobility and stability, in unequal societies, neighborhoods, and areas of cities may become identified by their income groups. With rich areas, we have gentrification, poor areas, and this leads to self-perpetuation. And if people feel like they have no idea, this tends to be self-fulfilling. The government does have a role in reducing poverty. They could do things like indirect taxes to address negative externalities, pursue environmental goals, help domestic producers. That's protectionism. They could do direct taxes on the wealthier class, which will impact aggregate demand. Taxes serve different purposes, but it can generate revenue for the government, which they can use for social programs. Progressive taxation is a system that means as income rises, they pay a higher percentage of income on their tax. Pay a higher percentage of tax on their income. Some countries also tax assets such as property like homes and cars. A regressive taxation system is one that takes a larger share of income from lower income people than from higher income people. It's generally not done deliberately. It's but just a nature of that taxation system. You see this a lot in indirect taxation when you're taxing goods that poorer people use. If we're trying to achieve equitable distribution of income, the government can do things like a progressive taxation system. There's a downside to this. According to a lot of economists, it's less incentives to work harder, and it disincentivizes entrepreneurship. The government can also do things like transfer payments for funds. Sometimes they're called welfare payments or social security payments. Examples of transfer payments are child support, maternity and paternity leave, old age pensions, housing allowance, We have things like universal basic income, fuel or heating allowance. Governments need to design policies that ensure equal opportunities for people at all income levels. Government should be encouraged to promote social mobility to create opportunities for improved health and education at all ages. Some of the suggestions that we learned about, that the textbook talked about, are universal health care, prenatal and postnatal care to low-income families, provided access to good quality childcare at preschool programs, school food programs, apprenticeships for older students, community programs to provide parenting support, and increased resources to support struggling senior citizens. Other suggestions are to reduce gender and other discrimination. It's the role of government to protect its people and promote policies of fairness. So they could do this by creating laws that you have to do equitable pay for both genders, positive affirmative action policies, legislation to make it illegal to discriminate, diversity quotas, and accessibility requirements. One of the other suggestions is increase the minimum wage. There is arguments against this, however, that we've talked about many times. And universal income. And just as a reminder, universal income is all citizens would receive a guaranteed amount each week or each month with no conditions or no eligibility. This is a suggestion that some countries have done. It was suggested by Andrew Yang in America. He ran for president with the Democrats in 2020 or 2016, one of those two. But it has been adopted by some European countries. The last thing we're going to talk about is types of governmental policy and economics. We're going to go to fiscal policy. Fiscal policy is pertaining to government revenue and expenditure. It's the total spending by the government. It could include things like capital expenditures, like building infrastructure, current expenditures, like wages, salaries, and transfer payments. Usually when we're talking about fiscal policy, we're talking about government spending and taxes, and these will increase or decrease aggregate demand. Here are the aims of fiscal policy. It's the same thing we've gone over before. Expansionary fiscal policy is a form of Keynesian economics, trying to use aggregate demand to control the economy. You could lower income taxes or lower taxes to increase disposable income. This will increase income and income and will hopefully increase consumption and investment, which will cause aggregate demand to shift. You can also do increased government spending, which will also cause aggregate demand to shift. Right here, if you look right here, here are some ways to do expansionary fiscal policy. The government could decrease taxes or they can increase spending. If you look right here, the government had a recessionary gap. This is the recessionary gap you would color, you would shade in, right, recessionary gap. And then it's going to shift from 80 to 81 because of a decrease in taxes or an increase in government spending. As far as this goes, we've talked about this before. Neoclassicists believe that wages are flexible, so an increase in aggregate demand will just cause another shift in SRAS, where Keynesians believe that wages are sticky, so that they believe that this is helpful. It will work. For contractionary fiscal policy, you start with an inflationary gap. You have an inflationary gap right here. Here's the inflationary gap. And the inflationary gap is right here, where the two intersections are. And what's going to happen is there's going to do a contractionary fiscal policy. They'll decrease aggregate demand by decreasing government spending or increasing taxes, which will cause a leftward shift, which is we'll get back to full employment. Again, neoclassicists believe that the economy is self-correcting, so they do not think it will do anything. While Keynesians do believe that you can decrease aggregate demand to decrease the price level. Fiscal policy is effective in the long run as it deals with deep recessions. It's useful in combating the deflation with expansionary fiscal policy based upon increasing government expenditure. It can be used to target specific sectors of the economy. The government can invest in parts of the country which they think that need it most. and they could provide tax cuts to people they think need it the most. There are constraints of it. There are time lags. It takes a long time for fiscal policy to be passed, especially since a lot of it requires legislation. Even when changes have been made, it does take a little bit of time, less than monetary policy, but it takes time. So fiscal policy does have a long inside lag, where it has a shorter outside lag. Also, fiscal policy can be constrained by political pressure, since it is part of the legislation process. Other constraints of fiscal policy is it can lead to an increase in sustainable debt, and that could influence interest rates and just increase the national debt. Also, it can affect net exports. Increased government borrowing may lead to an increase in interest rates, and if you have higher interest rates, that is going to lead. So, for example, if the government increases government spending to pay for their debt, it will lead to an increase in interest rates. If there's higher interest rates, there's going to be an increase in demand for the country's currency, which will lead to appreciation. If our currency appreciates, that means our goods are relatively more expensive, which will lead to a decrease of net exports. So that's one of the negative things. Government debt is the accumulation of all government debt, and it's usually expressed as a percentage of GDP. We're next going to talk about monetary policy. Monetary policy is policies relating to the central bank. Monetary policy is done by a central bank, and they're going to influence the money supply, which will influence interest rates, which will then lead to an expansionary or contractionary policy. The aims of monetary policy are going to be pretty similar to all the other ones we've talked about. So let's talk about expansionary monetary policy first. This is to increase aggregate demand. They do this by doing this, they're going to try to increase the money supply, which will decrease interest rates. By decreasing interest rates, it's going to lead to an increase in investment and consumption, which will cause aggregate demand to shift rightward. This is a slower process. Monetary policy has a shorter inside lag. It doesn't need legislation to be passed, but it has a longer outside lag. It takes longer for the actual policy to be felt because it's indirect. They're just increasing or decreasing the money supply indirectly, which will influence interest rates, which will then influence aggregate demand. These are the tools for expansionary and contractionary monetary policy. For expansionary, the Federal Reserve can buy bonds. They can lower the reserve requirements. They can lower the lending rates, the discount rates, or they could do quantitative easing. For contractionary, it will be the opposite. They could sell bonds, raise the reserve requirement, raise lending rates, or do quantitative tightening. And this is the money market graph. You need to know this graph right here. This right here is showing an expansionary monetary policy. We have DM, we have the interest rates, quantity of money. This is how you need to label it. They did some type of expansionary policy, like maybe they buy bonds. This is going to cause an increase in the money supply. As you see this, the interest rates will go down from I1 to I2. With the interest rates decreasing, consumers and businesses will be more likely to invest or do consumption, which will cause aggregate demand to shift rightward. So some of the strengths and weaknesses of monetary policy: it can be quick to implement. There's no political intervention. It's not controlled by the government normally, but a central bank and independent central banks. It doesn't have the crowding out effect, and it's able to make small changes. It could be more fine-tuned. There are time lags with it, however. It's quick to implement, but it takes a long time to notice the change. It doesn't have an impact on consumer or business confidence necessarily. It's done it's done more kind of like, for when legislation is passed, like there's stuff in the news about it. It's much more open to the public. Monetary policy is much more hidden necessarily, so it doesn't impact consumer or business confidence in much. And if interest rates are already really low, it doesn't have as much of an effect. Next, we're going to talk about supply side policies, and that's how we're going to be finishing up. Supply side policies are designed to increase long-run aggregate supply by increasing the quantity or quality of factors of production, by focusing on things like efficiency, technology, all those things that cause LRAS to shift. And supply side goals have the same 5 goals as the other one, but there are actually A little bit different. So the main goals of supply side are to increase productive capacity of the economy, improve competition, reduce labor costs, reduce inflation, and increase firms' incentives to invest in innovation. There are two different types of supply side, and there are subsections. There's market-based and interventionist. We're going to talk about market-based first. Market-based focuses on allowing the market to operate freely with minimal government intervention. They're designed to increase incentives for labor to work harder and more productively, and to increase incentives for firms to invest and to increase productivity. They want institutional or structural changes. The first subsection is incentive-based. Incentive-based market-based policies could be reduction in household income taxes and reduction in corporate taxes. There are other things that we talked about before, but these are incentive-based policies. One of the things we're going to get to at the very end is not only could these things cause long-run aggregate supply to shift, but they can also cause aggregate demand to shift. Even liberal economists support supply-side theory, but they more focus on the aggregate demand aspect of it, where supply-side theory is focus on the supply-side aspect of it. The next one is labor market reforms. Some of these could be like trying to reduce trade union power, get rid of legislation protecting unions, reduction or elimination of minimum wage, reduction or elimination in unemployment benefits. These are all labor market reforms promulgated by some supply siders to lead to long-term growth. The last one is economic competition reforms. We have deregulation, deregulating government-sponsored industries, privatization, the sale of government-owned businesses to the private sector, policies to increase competition, trade liberalization, so getting rid of subsidies, tariffs, and quotas. That is an argument that could lead to long-term growth. So when we're talking about like getting rid of a tariff, not only will you see that in the tariff graph and the international trade graph, but you can also show that with a long-run aggregate supply shifting to the right. Some of the limitations on market-based policies are the government does have a role in the market. Reduction of taxation could lead to benefit for higher wage earners than those of lower wage earners, so it could lead to increased inequality. Reduction of corporate taxes tend to benefit wealthy shareholders. The tax revenue that could be generated is lost to the country. Labor market reforms may lead to the reduction in standard of living. For deregulation, loosening of environmental regulation could have long-term impacts on sustainability. Privatization might not work if it leads to a situation where monopolies are created. In all market-based supply-side policies, there will be time that you have lags involved with the effects of these policies that are being filtered through the increased potential outcome. Next, we're going to talk about interventionist supply-side policies. These are policies where the government isn't getting involved and they're trying to increase long-run aggregate supply. We have an investment in human capital. This could be like paying for primary and secondary education, or even making college education free. And this will increase the productivity of the labor market. Remember, education is a merit good, so it's underprovided, so you need the government to get involved to provide some service. Another example of this could be providing healthcare. This could lead to an increase in human capital because people are healthier, so they're able to work more. Research and development is a second interventionist supply-side policy. Governments can encourage research and development by firms by offering tax incentives and subsidies, tax breaks to incentivize R&D. This can lead to new technological development, which will shift LRAS. The government can also directly finance R&D through public research facilities and universities. Provision of maintenance and infrastructure. The government can invest in infrastructure like freeways, highways. Under President Biden, they tried to do the EV stations, charging stations along the highways. That is an investment in infrastructure. That's actually a supply-side policy that was trying to fix infrastructure, although it also increases aggregate demand. You could do direct support for businesses and industrial policies. You could do this by anti-monopoly laws. Anti-monopoly laws would also fall under the competition under market-based as well. Some of the limitations of supply side policies would be there's a significant cost to these type of policies. Unlike market-based policies, they do cost money. If spending is funded through borrowing, it could create indebtedness. There'll be time lags before the full effect is felt. Spending can be deemed political, and policies and priorities can be changed based on elected officials. Lastly, we're going to talk about how demand affects supply. Market-based policies, like reducing household income, will also have expansionary fiscal policies. So in the short run, they could be expected to increase aggregate demand. In the long run, it could cause LRAS to shift. So like if we decrease income tax, you are going to see LRAS to shift under supply side theory, but you'll also see aggregate demand to shift. Interventionist policies will have the same thing. Increasing investment, the example I gave earlier, could have AD shifting and LRAS shifting. An expansionary fiscal policy involving lowering household income taxes may increase incentives to work harder, and they become more productive. Thus, this will create the potential output of the economy. This is why we say it causes long-run aggregate supply to shift to the right. Expansionary fiscal policy involving an increase in government spending may have strong supply-side effects depending on the direction of the spending, like we talked about infrastructure and investment. And right here, just before we end, is showing a graph showing that the relationship between supply-side policies and how it could impact aggregate demand and long-run aggregate supply. All right, kiddos, that is all I have for you for today. Until next time, deuces, deuces, yeah.